Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, I wanted to cover five investment considerations for business owners in a down market. As you know, asset prices are down across the board right now. Stocks are down, bonds are down, alternatives, real estate, everything's down right now because interest rates are going up. And as a result, we have some things that we should consider as investors given the state of the economy and the markets. And today I wanted to cover five things that I think business owners particularly should consider given this environment. Not all five of them are specific to business owners only, but a couple of them are. And all three I want to frame in a context that's helpful to you business owners out there. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. So as I'm sure you all have observed recently, the markets have not been terribly strong of late. We've got inflation, we've got rising interest rates that's pushed down both stock and bond prices. We have the war in Ukraine. That's part of the reason that energy prices have been high. We have a lot of things going on that's not been kind, that have not been kind to the markets. So today on the podcast, I want to share a few considerations, a few tips for business owners, a few investing tips for business owners, I should say, things that you should consider in a down market. Some of these will be investing tips ubiquitous to any investor, particularly in a taxable account. Others are going to be specific to business owners and are suggestions that I think most businesses ought to consider given the circumstances we're in right now. Now, the first one I want to cover is tax loss harvesting. This is not specific to business owners, but if you have investments in a taxable account and you have unrealized losses, because let's say you invest $100,000, now the market's down by 20% and your investment is down from $100,000 to $80,000, well, you might want to think about harvesting that loss because that's beneficial from a tax perspective long term. Here's how it works. If you have a position that is sitting at a loss that's not been realized yet, you sell it. So in that example, you have a $100,000 investment that's now worth $80,000. Well, you might want to think about selling it and harvesting that $20,000 of loss. If you've held the position for less than 365 days, it's considered a short-term loss. If it's longer than if you held it for longer than 365 days, it's considered a long-term loss. Now, you might not want to adjust your portfolio. Long term, we're not trying to sell securities when they're low. If you've listened to the show at all over the past, you probably know I'm a proponent of long-term consistent investing and waiting for the market to do its thing and recover on its own over time. We want to let the markets do the work for us because we can't predict what direction they're going to go in the short term. And that's exactly right. We don't want to sell the position and be penny wise and pound foolish and sell the position because we want to harvest this tax loss and then neglect the fact that we want our investment to recover. That's not the idea. When we harvest losses, what we want to do is harvest the tax loss because that kind of goes in the bank, the quote unquote tax loss bank. And I'll circle back to that in just a second. But when you sell the security, now you have $80,000 in cash. What you can do is purchase a similar security that's a little bit different with that $80,000 in a way that doesn't materially alter your portfolio. So one example of that would be is if you have a mutual fund investment that's down $20,000, you sell it, you get $80,000 back. Well, if that mutual fund was tracking the U.S. broad market, the broad U.S. stock market, you could buy an exchange traded fund with the cash that's different enough to where your portfolio's exposure is the same, but it's the security that you purchased is just different enough to be able to harvest the loss. Now, you might think, well, why don't I sell the mutual fund on day one and then just buy it right back the following day? You can't do that. There's an IRS rule called the wash sale rule, where you have to be out of the position for at least 30 days in order to harvest that loss. So if you buy it back, you don't get to harvest the loss, and it's just added to the basis of your position. So it does help you in the future. But by and large, what we want to do is harvest those losses on a year-to-year basis and put them in the bank. Now, at the end of the year, what you do when it comes time to file your taxes is you total up all your long-term gains and losses and all your short-term gains and losses. So if you have $20,000 of short-term losses from this position that you just harvested, well, that means that you get to offset that against other gains. So if you have other positions at a gain this year that you've harvested, say you have $15,000 of gains, that means that you don't pay any tax on the $15,000 of gains. The $20,000 of loss offsets it, and now you have $5,000, a net capital loss of $5,000. Now, the cool thing about this is every year, if you have a net capital loss, you get to use $3,000 of it against your income. So if you make $150,000 in a year and you have a net capital loss of $3,000, then your income you get to use that on your tax return and reduce your income from $150,000 to $147,000. Everything else, so in our example, the $2,000 left over from the $5,000 that you had netted against your gains, that carries over to the next year. And if you don't have any gains the next year, then you get to use the remaining balance against your income the following year. And you keep working that down by $3,000 every single year. So the way it works is you net your short-term gains and losses together throughout the year. You net your long-term gains and losses. And then after that, you net you balance the short-term versus the long-term gains and losses. So if you have $10,000 of long-term losses and $5,000 of short-term gains, net those together, you have a net $5,000 net long-term capital loss. So that's idea number one. We want to harvest our losses without substantially altering the portfolio. We want to remain consistent in our target allocation long term, because as we talked a little bit about last week when I went on a rant about the 60-40 portfolio, that's what's going to lead us to the best outcome. We want to maintain a consistent portfolio allocation, but we want to put those tax losses in the bank as the opportunity arises. When markets are down, you probably have some losses in a taxable account. So that's idea number one. Idea number two is we want to think about Roth IRA conversions or other means of accelerating income. And so I say this because oftentimes when the markets are down, that happens to coincide with a tough time in the economy. And when the economy is tough, that often results in poor business profitability. So the years that your investment account might be down often coincide in years when business performance is down. So anytime that our income is down, we want to think about filling up those lower tax brackets. And there's a couple ways to do that. If you have expenses coming up this year that you can defer into the next year, well, that's helpful because we want to, if you're in a lower bracket this year, let's say you're in the 22% tax bracket and you have a $10,000 expense, that $10,000 deduction reduces your taxable income when you're paying 22% on it. But let's say next year things recover and you're back in the 35% bracket. Well, that $10,000 deduction is going to be worth more to you next year when you're paying taxes at 35% than it is this year when your marginal rate's 22%. So in years where your income is down, we like to think about postponing deductions wherever possible. We also want to think about accelerating income. So if you have invoices or other activity that you can jam into this year when your income's down, that's not a bad idea. Because again, we pay tax at a lower rate now than we would in the future after things recover. Now, the other side of this is in your investment accounts, in your retirement accounts, I should say, you might want to think about Roth IRA conversions. If your income is down and you fall into a lower bracket, we really like to fill up those brackets. And if it's not with income or expense tinkering, like I just mentioned, another way to do that is to convert assets in your qualified accounts, your 401k, if the 401k allows it, or your IRA to a Roth IRA. When you do that, I've talked about this ad nauseum on the podcast over the years, so forgive me if this is repetitious to some people. If you take $10,000 in your IRA and move it over to your Roth IRA, that immediately triggers a 1099 for $10,000 of taxable income. But once the 10 grand is in the Roth IRA, you never pay tax on it again. So it's helpful if this occurs in a year when your income is down because you're paying the tax on that additional 10 grand at a lower rate when you're in a lower bracket. Now, the other side of this, so aside from what bracket you might be in this year as a result of business performance, if we have a choice between doing a $10,000 Roth conversion when the markets are high versus a $10,000 Roth conversion when the markets have just fallen, we always like to do it when the markets are down. And here's why. If you've determined that you have $10,000 of room until you hit whatever that next tax bracket is for you, then what you're trying to do is move securities from your traditional IRA or your 401k into the Roth account. And what you're going to do is total up securities to where the sum value that you're moving over equals exactly $10,000 or something very close to that. So if the markets are high, let's say it's an S&P 500 index fund that trades for $100 a share when the markets are high, then if you're trying to trigger a $10,000 conversion, that means that you move 100 shares of that index fund over to your Roth IRA. And based on the value at the time, it's going to trigger a 1099 for $10,000. You filled the room you have remaining in that bracket, and you're in good shape. Now, if the markets fall by 25% and the value of that same security is no longer $100, now it's $75 a share, well, guess what? If you move 100 shares over to your Roth IRA, you're only triggering $7,500 of taxable income, which means that you have the opportunity to jam more shares of the same security into your Roth IRA when the prices are down. This is really, really helpful. So aside from the fact of bad market performance often coincides with bad times in the economy, if your income is down because business is just down this year, that's one thing. And that would make me think that you want to accelerate income or maybe kick out business deductions into future years or trigger a Roth IRA conversion. But if the price of your securities, if the value of your investments is down anyway, that creates a great opportunity to just get more shares of the same thing into your Roth IRA for the same tax bill. So it's a great opportunity for that. Now, the other thing that I want to mention with regard to investment accounts, and this is true for business owners and non-business owners out there, is that sometimes in active mutual funds, active fund managers in down markets are sometimes required to distribute substantial capital gains to shareholders. Last year, 2021, happened to be a big year for capital gains distributions. That made a lot of people really upset because mutual fund managers, either they saw outflows or some kind of turnover in their portfolio. There are a number of different reasons. In Vanguard's case, one of their target date retirement funds, they had a different share class available. They made a different share class available. So all their investors in the first share class sold in order to move their money over to the new share class, which is less expensive. Well, when the holders of a mutual fund sell their shares, the mutual fund manager is required to redeem them for cash. And so to raise that cash, they'll often go into the investments in the portfolio, the stocks and bonds, and sell them to raise the cash. It's typically what happens. Well, this can require them, when they harvest those gains and losses, it often requires them to distribute the gains back to shareholders. So if you own shares of that mutual fund, you might get this big tax bill at the end of the year for capital gains, either short-term or long-term capital gains that the fund paid out. But you might not have even sold any shares of the fund. This happens all the time, and we need to be aware of forthcoming distributions from mutual funds, because you have an opportunity to sell your position in the fund before that happens, number one. Number two, it doesn't matter what your behavior is related to whether or not you're going to get one of these things. What matters is all the other investors in the mutual fund. And if a lot of people sell, a lot of other investors in the fund sell, that means that the manager is going to have to sell the underlying positions to raise cash, and that could result in a big tax bill for you. Now, when markets are up and some people sell, that can create a big distribution. But on top of that, when markets are down, that can often create big distributions in actively managed funds. It doesn't happen so much in passive funds, but in actively managed funds, when markets are down, that causes investors to sell more frequently than it does in passive funds. And here's why. If, back to our S&P 500 example, if we're putting our money in a passive S&P 500 index fund, we're investing in the market, we're paying a mutual fund manager to replicate the S&P 500 by going out and purchasing each company, each of those 500 companies, and then putting them in the portfolio for us. We're not betting on the skill or intelligence or forecasting ability of the manager. That manager's job is operational. They're just trying to replicate the 500 companies and do so in the most cost-effective way. So when markets are down, in index funds, more often what we see is money flows into those funds because new investors are trying to invest at a low valuation. But in active funds, they're not replicating an index. You're giving a mutual fund manager your money to invest on your behalf in some strategy. They're forecasting the markets and the economy, and they're making active bets on whether one company is going to do better than the other and where their exposure should be based on the prospectus and strategy for that fund. And so a lot of the performance comes down to the ability of the individual or the team managing the portfolio. Well, if the markets are down and the value of that fund is down, that implies that the team has not done an adequate job of what they promised they would do. In an index fund, there is no manager making those active bets and doing that active analysis. When markets are down, there's no one to blame, really. But with the active fund, they have a team who's supposed to shield you from some of that risk. And if the value falls, then there's blame to be placed on that team. And a lot of investors decide to sell their investment as a result. So in down markets, oftentimes what we see is outflows, more outflows from active funds than we do from passive funds. And as we know, when the outflows happen, the manager is often compelled to sell positions. And when markets are down, just like you and I don't want to sell positions at a loss, the managers are often reluctant to do so, and they'll often sell positions at a long-term gain instead. So if you're someone who invests in actively managed mutual funds, be aware that this might be a year where you see capital gain distributions that you might not otherwise want. And again, you can stay on top of this. The companies communicate what they expect their distributions to be beforehand. So you do have an opportunity to trade out of it, but just be aware of what's going on if you're an investor in actively managed funds. Now, rebalancing should be a no-brainer, but when I'm going to mention it as our fourth investing tip in down markets because it's important. When markets are down, it's likely that that the different asset classes in your portfolio are going to change in value by different amounts. Usually, stocks fall by more than bonds. If you've got a 60% stock, 40% bond portfolio, you might find that after a market correction, now you're down to 50% stocks and 50% bonds because the value of your stocks has fallen. Maybe the value of your bonds has fallen, but not by quite as much. The allocations and the portions of your portfolio will change over time based on the performance of each of these asset classes and the underlying investments in them. So when markets are down, we have a period of volatility. It's a nice opportunity to rebalance and harvest losses simultaneously. Remember back to our first point, if you have a position at a loss, you can sell it. You can buy back a very similar but just a little bit different security to maintain the constitution of your portfolio. It's a nice opportunity just to bring it back to your target allocation simultaneously while you do that. One quick note too, I mentioned the wash sale rule and that you have to be out of a position for 30 days and all that. Cryptocurrency is not currently subject to the wash sale rule. You can sell it, you can buy it back. I would probably wait until the next day to do it. So if you have a statement showing your transactions, there are two different dates. But you can harvest the loss for tax purposes and only be out of the security for a short time. So whereas with more traditional investments, we have to be out of the investment for 30 days in order to book the loss. Therefore, we want to reinvest in something just very slightly different but substantially similar. Cryptocurrency, that's not the case. You can sell Bitcoin and then buy it right back shortly after and still claim that loss based on the current tax code. We do have some more regulations coming down the pipe for cryptocurrency that may change that landscape, but for now, it's doable. Now, the other thing so the final one that I wanted to highlight here is pretty basic, but when markets are down, it's a good time to put more money to work. So if you're a business owner that has a qualified retirement plan, SEP IRA, simple IRA, 401k, cash balance plan, defined benefit plan, your ability to put money away tax deferred obviously depends on the structure of that plan. And some of these things, you can make your deposits and contributions earlier in the year. Now, because markets are down, that's a pretty darn good time to accelerate those contributions that you might have planned for later in the year. So if you have cash laying around, number one, it might be a good idea to max out your own 401k contribution. And if you're someone who contributes a little bit each payroll cycle to the 401k, let's say you have yourself on payroll because you're an S or a C corporation, well, you could bonus yourself out, give yourself, if you have $10,000 left before you hit your annual limit, which this year is $20,500 of employee deferrals, give yourself a bonus that to where the net result after your payroll taxes is $10,000 and defer all of that into the plan. So I'll break that down a little bit more specifically. We pay payroll taxes of 7.65% on any payroll bonus. So if you have, 15 grand laying around, you're not sure what to do with, if you give yourself a bonus of $10,000, you run it through your payroll system and defer 100% of that into your 401k plan, you will wind up with a deposit into the 401k of less than $10,000 because you had to pay payroll taxes of 7.65%. So 100% minus 7.65% is, I've got a calculator here. I can do it in just a moment. Round it off to 92%. So you get around $9,200 deposited into the 401k after paying the payroll tax on a bonus of $10,000. So what you want to do is divide $10,000 by 1 minus 0.0765. So you give yourself a bonus of a little bit more than $10,000 so that after payroll taxes are taken out, the net deposit is 10 grand. So that's one thing I would consider. If you have a 401k plan, accelerate your own contributions to the plan because markets are down. This is a pretty good opportunity. On the other hand, you can also, if you have a SEP IRA or a solo 401k, you can think about making employer contributions based on your compensation year to date as well. This is a little bit sticky because if you, let's say you have a SEP IRA, the limit to the contribution limit this year is $61,000. Well, you have to have enough self-employment income in order to substantiate that contribution. So if you have a sole proprietorship or a single member LLC, you need to have around 5 times that much income in order to maximize your contributions, or around 300 grand of income. So let's say that you're tracking for 300,000 of self-employment income. You cut a check to your SEP IRA to deposit $61,000, and then you get to the end of the year and your income is $50,000 shy of where you thought it would be. As good a time as it is right now to put more money into your retirement plan, we don't want to overshoot because it means that if you contribute too much, you'll have to turn around and take money out before you file your taxes for the year. And you have to do this whole calculation of how much did you contribute, what was the growth in the account between now and then, and you have to take out the excess contribution plus the growth of that excess contribution by the time you file your tax return. And if you don't, there's a 6% penalty per year that we really want to try to avoid. So you can make your employer contribution to a retirement plan earlier in the year if you want to. We just have to make sure that at the end of the year, you have the income to substantiate the contribution later. Now, some people out there, so if you have employees in a 401k plan, the amount that the business puts into the 401k plan on you and your employees' behalf depends on some kind of formula. I would suggest not making changes to the timing of your 401k employer deposits at this time. Markets are down. It's a great time to put more money in. But if you make changes to that, you need help from your administrator usually, because your plan document will specify exactly how much you can put in, how that structure works, and when you should put that in. Some plans, it's okay to put in throughout the year. Other plans, it's a lump sum contribution at the end of the year after the books are closed before you file your taxes. It depends on the specifics of the plan. So don't accelerate it too much, number one. And number two, make sure that you're abiding by the stipulations in your plan document. Now, for those of you out there that have cash balance plans or defined benefit plans, the takeaway here is that you need to be prepared for a larger contribution next year. Because remember how those plans work. You're promising some kind of benefit to yourself, your future self, or your employees over a period of time. So the benefit is defined. And in order to define that benefit, your plan is assuming a certain amount of growth on plan assets every single year. So if you assume 5% annual growth in a defined benefit pension plan, and then stocks and bonds are down and the value of the holdings in that plan account is down, guess what? You have to make up that difference with a larger contribution. So if you have a defined benefit plan, if you have a cash balance plan, because the values of stocks and bonds are both down right now at this point in the year, and probably will be by still when we close the books after December 31st, you should be prepared to make a larger contribution to the plan than you have over the last couple of years. last couple of years, it's likely that your performance has been better than was expected in the plan document. This year, it's probably going to be worse. So keep some extra cash aside. That's, if you have a 401k and a cash balance plan, that might make me think twice about accelerating 401k contributions right now. Unless you have unless you're awash in cash and you have plenty of flexibility to make those contributions when it comes during tax time next year. Okay, so those are the 5 things that I wanted to cover. Some of them are specific to business owners, some of them are not. Just to recap, you think about harvesting losses. We need to be cognizant of the 30-day wash sale rule, although that doesn't apply to cryptocurrency. We should think about accelerating if your income is down. We should think about accelerating income and revenue and deferring deductions. We should also think about Roth IRA conversions because we can get more securities into the Roth IRA for the same tax bill when the value of those securities are down. We need to be prepared for larger distributions than usual from actively managed mutual funds. So if you have an actively managed mutual fund in a taxable investment account, that's what you need to keep an eye on. If it's in a 401k or an IRA or a Roth, doesn't matter. You don't need to worry about it. We need to think about rebalancing, which can often be done simultaneously with loss harvesting. That's how we do it on our firm. And we want to think about accelerating contributions to your retirement plan. Stocks and bonds are down. The more money you put in now at lower prices, the better your long-term returns are going to be. So that's it for today. I hope this was helpful. Some of it I hope was not redundant from future or previous episodes. Some of these points we've covered in the past, but we haven't covered all of them. So be good, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.